Paul, you're into the fine wine, the Cabernets, the
For those of you,
the filet mignons, the tomahawk, but yet you're not into any of that because you'll take a date to McDonald's.
I don't think I've taken dates.
That is the McDonald's Platinum Club member.
No, this is a McDonald's gift card that Darnell got for me.
You have Egg McMuffin juice flowing through your body right now. You love McDonald's.
I do.
You pull up in the Bentley.
They must think I'm like a ridiculous person. They're like, what are you doing here?
So are you buying McDonald's stock? I assume because most of their profit is coming out of your wallet.
Yeah.
Let's look at the 8 pillars behind McDonald's, not just the ticker price, which is high to a normal person. And
so we have a guest here today.
We do.
Who's the guest, Seth?
Your brother.
My brother said to me this weekend.
Go on.
If you don't get a blue check mark on Instagram, I am done with you forever. So would you please follow us on Instagram?
It's not true, but...
because my brother's belief and admiration of me. He's 8 years younger than me. And so somebody asked me this weekend, like, they said something like, which brother loves the other one more? I said, my brother loves me a ton. I have an unhealthy obsession with my brother. And she's like, that sounds about right.
You do. And you have an unhealthy obsession with the
McDonald's.
Grease. Yes, the grease at McDonald's.
Yeah, I do.
Tell me what the market cap of this
company
is.
All right, $178 billion market cap. The 5-year PE is 31.7. We want it less than 22.5. So that's an X. And for a company like Microsoft, I mean, where's the growth coming in Microsoft?
Microsoft? I don't know, because we're talking about McDonald's.
Why am I saying Microsoft? Where is the growth coming for a company like McDonald's, right? How many locations do they have?
More stores.
They have 39,000 stores.
Oh my gosh.
So for them to grow 1% in their stores, it's 390 stores. That's 7 per state every single time they want to grow 1%. That's a lot. Now, granted, there's international growth they have, but I mean, you're not going to double your stores in 2 or 3 years,
As
right?
the world gets healthier, do you expect McDonald's to go down?
Can you please show me any sort of medical research that says McDonald's is unhealthy?
I cannot.
Thank you very much.
I would assume
you burnt
French fries.
Tap the mic. Okay, but here, look at this: 5-year return on invested capital, 9.9%. We want that above 9%. It shows that they make a good return on the money that's invested in their business. That's one of the big drivers of reinvesting cash and things like that. Now, dividend yield, 2.1%, $3.8 billion. Seth, please explain to our users what this $3.8 billion dividend means.
Well, they have to have that money in their free cash flow to be able to pay you that dividend because it's not locked in.
Right.
And Paul, the Hamburglar, will tell you how they do that. Go ahead, Paul.
So their free cash flow last year was $5.3 billion. And their average in the last 5 years is 4.6. So that's eating up a big chunk of their cash flow, which I would argue is probably okay to attract investors to this 2.1%, but it is eating up a lot of their free cash flow. Now, the question is, how capital intensive is a business like Microsoft? Like, their business model is...
You just said Microsoft.
Darn it. How capital intensive is a business like McDonald's?
You tell me.
I don't know. We're going to look at the cash flow statement to figure that out, but as long as they don't need a lot of capital around their, which I don't think they would, because I don't know how the business works, but they have a pretty good arrangement with franchisees. I think franchisees build the stores. Mikey, did you ever look at that?
They revamp their stores all the time.
Oh, yeah. The revamping is happening now. It looks great.
It's incredible.
So my brother, he has a couple of friends who have McDonald's stores.
Oh.
Yes. So I think what they do is the franchisees, the McDonald's owns the land, the franchisee builds the store, they do a lease that's based on a minimum. And our friend, our CEO, Tim here, was a McDonald's employee in high school and college. Not college, just high school. Just high school. So anyhow.
Let's look at the profit growth over the past 3 years, Paul, I assume.
We should look at the revenue growth first.
Oh, yeah, revenue. I assume you're afraid of clowns.
24 billion down to 21.4. So look at this, Seth. 27.5 10 years ago. 21 now.
Well, I'm sure they opened an S-ton more of stores.
Yeah, so you have to wonder, why is their revenue down so much?
Profit growth is pillar number 4, Paul.
But why is their revenue? That's one of the first questions I have. Why is their revenue down so much?
That wasn't rhetorical. I have no idea. Yeah, that's wild.
5.08 to 6.9. So the revenue is down, but the profit's up. That's good. Okay. Are they becoming more lean?
Probably not. Shares outstanding is pillar number 5.
812 million down to 746.
That's nice.
10 years ago, they had $1 billion. So they're down 25% over the last 10 years in number of shares outstanding. That's pretty sick.
After you eat a Happy Meal, Paul, where can people get this data behind you?
So we created this data because people kept asking us, hey, where can I get this data? So we're like, oh, we'll just make it for you instead of you paying $200 a month to Y Charts. So what you get with the data is mobile app, 8 pillars, 30 years of financial data, stock analyzer tool, exclusive daily content. We're going to send multiple videos per day to those in the app and the software. It will not go on YouTube. Access to all of us, real estate calculator. Most importantly, Discord community. We have over 5,300 people in our Discord talking about investments in different chats every single day. Thousands of messages exchanged per day, not hundreds. Thousands of messages exchanged per day, all for 84 cents a day, which is less than a delicious cup of coffee.
Crappy cup of coffee from McDonald's.
But I will say, I've heard my brother loves McDonald's coffee.
I went to a Dunkin' Donuts with your brother. He said it was good coffee, and I almost threw up in the Bentley. He's a bold-faced liar, and I wouldn't trust him.
You were mad about the Dunkin' Donuts coffee? I have connoisseurs of coffee who are friends who love McDonald's coffee.
If you want this data, you want the software, join the Patreon.
84 cents a day.
You can jump around with Paul in the ball pit at McDonald's because he fits in there, Paul.
Anything that happens in the ball pit stays in the ball pit.
Pillar number 6 is total long-term liabilities. I love when we transition right into these nerdy numbers. Total long-term liabilities
from the inappropriate
divided by 5-year free cash flow.
So their total long-term liabilities is $54 billion. So we want to see that ratio of 5-year free cash flow to be less than 5, which means they need about almost $11 billion in yearly free cash flow.
Okay.
They ain't got it. Remember from before, guys? Oh. Their average is 4.6. Uh-oh. So they're selling for roughly, what is that, 10, 11 times their free cash flow in terms of the number of debt. So their free cash flow is up over the last 5 years, 4 to 5.3. And the average is 4.6 billion. So what we do here is that we multiply it by 20 to give us around a market cap we want to pay for the company, right? That is $92 billion. What's the market cap?
It's $178 billion.
So it's about double.
Uh-oh.
So guys, this is just expensive to me. Now we'll put it in a stock analyzer tool to assume the revenue, but remember, revenue is down in the last 5 years. So actually look at this. We actually have 4 X's here. Too high, 11.7 times. I mean, this just looks... Yes. This one, I'll tell you what, this doesn't bother me as much. The free cash flow for long-term liabilities, for such a stable company that everybody loves, I'm not as concerned about that. But I'm very concerned about why revenue growth is down with a company that's growing. We got to understand that. I have no idea why that is. And these ratios are just way too high. You're paying 32 times average profit of the last 5 years. And free cash flow, 39 times the 5-year average free cash flow. This is just way too high.
Yeah, so if you're a new investor and you've heard this term value investing, this is what we do here. We want to find great companies at a low price. This is a not growing company in terms of revenue at a very, very high price, the exact opposite. So what Paul is doing is he's going to use the stock analyzer tool you can get as a patron to learn how do we transition all of these pillars into what we should be paying for McDonald's. The current price is $240 a share. I would imagine, Paul, that have they done a stock split before? I feel like this is the type of company that needs a low stock price. It's not luxurious, like a Ferrari or a Louis Vuitton. And I guess if you watch other videos out there, they would say this is kind of an expensive stock, $240 on McDonald's.
Well, I didn't even look at the share price. Look at that. How far into our video, I didn't even know the share price, right? So guys, I'm making some assumptions here. Revenue growth, even though revenue growth is down for the last 10 years, I'm still going to assume 1.5% to 3.5%. Shares outchanging, I went from 0% to buying back 3%.
Outchanging, I love it.
What was that?
Yep, go on.
Profit margin, 20 to 24. Free cash flow margin, 18 to 22. Now here's my multiples. For PE and free cash flow, guys, this is a huge company. I'm going to be conservative and call it 10 to 16. I don't know that's the right number. Some can make the argument if 15 is the right number for McDonald's. I don't know, but let's just go look at the numbers now. We hit the analyze button, guys, and we're looking at a price somewhere in the 70 to 80 range to pay for McDonald's to get a 12.5% return. In the low 100s, like 120 to 130 for a 10% return. This is just way too much. And look at it. Selling for 38 times free cash flow. Divide that in half. You look at that going, okay, this is about buying the company about half the price it's at right now. I just think this is too much. I don't know why it's selling for so much. Is it because last year's free revenue growth was 13% and people were excited about that? Probably. But I just think that's too much money to pay for a company like this. And I'm assuming revenue growth, even though the last 10 and 5 years have been declining revenue.
Someone in the comments is going to write below, they're going to say, Paul, that this is a real estate company because the McDonald's buys up every highway exit, the land around there. Have you heard this?
Yeah, and guess what? I don't disagree with that. But at the end of the day, guess what real estate is? It's a play on free cash flow. How much cash can you generate from a piece of real estate? It's no different. Now, does that make it less risky because there's assets behind it? Sure, I can make that argument. And that's why I agreed with the whole long-term liability. I didn't worry as much about that with the assets behind it. But
so whether there's a hotel or a McDonald's on that land, they need to make money on it.
And by the way, they don't own the land all the time. Sometimes it's investors. They sell to investors like us sometimes saying, hey, we'll give you 4% a year. And people are like, oh, we'll buy it. It's like 4% a year? Mm-hmm. Come on, give me a break. So I just look at this saying, guys, this is way too expensive. I don't know what to tell you. Besides, I mean, even if you change these multiples, you're still not going to get to a high side 150 to 160. It's still just too expensive. I don't care how great my McDonald's is. It's just way too expensive.
That's our take at McDonald's. You can join Paul here in Richfield, Ohio, or you can go to a very nice restaurant and get a filet mignon. He still puts ketchup on that as well because his palate is just so refined. Paul, that's you. Join the Patreon. Fondle thumbs up on the way out. And play with Paul in the ball pit there. In Akron. He'll be there jumping around, frolicking at McDonald's.
Thank you very much, guys. Follow me on Instagram.
That's our take. Love you.